So thank you again for joining. I'm glad to be here. My name is Rich LeBranti. I am the investment advisor on the Night Shift 401k plan, and looking forward to having a chat with you all today and hoping to share some good information that can add a little bit of value to your retirement planning. Today, we're going to cover a plan overview. So look at the specifics of the Night Shift Brewing 401k plan. Talk about pre-tax versus Roth contributions. When I do get calls and emails from participants, 9 out of 10 times, part of that conversation is, should I be using pre-tax contributions versus Roth, a combination of both? So we'll dive deep into the differences between the two and chat about what might be right for you. And then we'll end with some 401k mistakes to avoid and some ideas that I can share in regard to kind of how you might be able to better meet some of your goals. So talking just about the overview and the plan highlights. So eligibility for the Night Shift Brewing 401k plan is all employees age 21 with 3 months of service. So once you meet that service requirement, you will automatically be enrolled into the plan at 3% of your pay. That 3% is automatically enrolled into the pre-tax portion of the 401k. So if you wanted to increase or decrease or change your contribution type or add your contribution type with Roth, you would have to manually go in and do that. So the automatic enrollment is just the 3% at pre-tax. The contribution limits for the 401k for plan year 2022 have actually increased from 2021. If you're under age 50, you're able to put $20,500 away into your 401k pre-tax or Roth. And if you are over age 50, you can put an extra $6,500 to go up to a max of $27,000. Those numbers should kind of get the wheels turning a little bit, saying that the federal government is allowing us the opportunity to pre-tax, just over $20,000 up to $27,000 into the 401k plan, and giving this great opportunity for participants in 401ks to do that, because they know that a lot of people have kind of fallen short on their retirement planning goals, and they're really giving us this great bandwidth in order to save. So those are the maximum contributions. That's not what you have to do, but what you can do up to if you're under or over age 50. As I had mentioned, the plan does allow for both pre-tax and Roth contributions. And we'll get into a little bit more of the specifics as we go along there in a couple of slides. Rollovers from prior retirement plans are allowed, as well as rollovers from IRAs. What I will say here on this point is that in order for you to roll funds into the Night Shift Brewing 401k plan, all of that has to be initiated from the prior record keeper. So if you did work at another company and you're looking to roll an old 401k to the Night Shift plan, you want to make sure that you contact that company or the record keeper where the money is at, Fidelity, T. Rowe Price, Empower, wherever it might be, and have them tell you the process in order to get the money over to Night Shift. There is a form that we can provide to you that must accompany the check that you receive from that past employer. And that form also has the instructions on how to make the checks payable. So if you know you want to do a rollover from an old retirement plan or an IRA into the Night Shift Brewing 401k plan, get in touch with us for that form, and then get in touch with your old record keeper or employer to get those funds over to the Night Shift plan. There is a match on the 401k plan, and the match is 100% of the first 3% of an employee's pay, and then 50% of the next 2% of pay, which basically comes out to a 4% gross match. In order to maximize the match, you would want to be saving 5% of your pay in order to get that full 4% in the match. Encourage people to save more than 5%, because that will obviously get you to a point where you'll better meet your retirement goals. But if you want to maximize the company match, you should be saving at a minimum 5% of your pay. The match goes in only pre-tax. That does not go in Roth. So even if you are saving in both pre-tax and or Roth or one of each, the match is always going to go into the pre-tax bucket for you. within your 401k plan. That match, because this is a safe harbor plan, is always 100% immediately vested. There are also the ability to take a loan out of the 401k. You can basically take a loan against 50% of your vested account balance up to a maximum of $50,000. One thing I would caution on loans is that if you are going to take a loan, you really should do it for something where you'll have the ability to build a little bit of equity. If you're, buying your first home or an investment property, or helping to educate your children, that could be a good use of funds for a 401k loan. If you're planning on taking a vacation or maybe spending that money on something that isn't going to build you some equity, I would say that maybe avoid taking the 401k loan for something that doesn't provide that much value to you. The last thing, and less of a plan highlight, but more of just a planning topic and idea, is make sure that you name a beneficiary on the 401k plan. I can't stress this enough of how important it is to make sure that a beneficiary is named. God forbid if you pass away and you're married and your spouse is not named as a beneficiary, or somebody else's name that you really didn't want, or you go through a divorce and your ex-spouse is still named. A beneficiary designation on a 401k plan, an IRA, a Roth IRA, a life insurance policy, all of those beneficiaries supersede what's written in a will or a trust. So if you had the intentions to leave all of your money through a will or trust to one person, and a different person is named as your beneficiary, there's nothing that person named in the will can do. The beneficiary on these plans are law, and they supersede what's written in a will or a trust. So I highly recommend to make sure that you check your beneficiary designation, and that is the appropriate person or people who you want listed to be a beneficiary. So investment options within the plan. There's a couple different ways that you can invest. There's 35 individual investment options. That's what we would call kind of the do-it-yourself way to invest. You can pick and choose any number or combination of those individual investment options and build your own portfolio within the 401k. This is what's determining what's going to happen with the money. Many of those investments are stock market investments. Some are also bond investments, which tend to be a little bit more conservative, and some are kind of stable value and cash investments. So they range from very, very aggressive all the way down to very conservative. You also have the ability to use what's called target date funds within the plan. And this is a little bit more of kind of like wanting to have someone do it for you, the investing, or kind of like a set it and forget it approach. The target date funds are institutionally managed funds that are a collection of mutual funds that T. Rowe Price puts together, and they base those investments on your date of birth. So if you're 35 years old today and you're going to retire at your age 65, which is 30 years from now, you would likely be put in the target 2050 to 2055 fund. And 2050, 2055 represents the year closest to when you may retire based on your date of birth. So the farther out those years go, the more risk you would take in the portfolio. You will automatically be invested if you don't pick a fund for yourself into the target date based on your birth date, but you can always go in at any time and change these investments to be more or less aggressive, individual, target date, or a combination of each, however you see it appropriate to build that portfolio. If you have some questions about, how much risk should I be taking, how much should I be saving, what collection of investments should I be using, I would encourage everyone to get in touch with us. We are, as I said, the investment advisors of the plan. We're compensated by night shift to help you, make the right decisions, and would love to hear from you if you need some help, working through what kind of investments that you'd like to choose. But a very robust plan as far as investments go. So that big question about pre-tax versus Roth, what's right for you? Should I be doing one or the other or a combination? Is really a personal decision. There's no right or wrong answer for this, but there are some specific instances where pre-tax and or Roth or a combination could work for you. And what I'll do first is talk about the difference between the two, and then talk about some scenarios where, Roth might make more sense for folks. So pre-tax really is what it says it is. The money that you deduct from your paycheck into the 401k comes out of your paycheck before tax. So for instance, every $100 that you pre-tax into the 401k is going to be about $75 less approximately per paycheck, because you're taking that money out pre-tax before all of those other line items on your paycheck. The money in the 401k in a pre-tax bucket grows tax deferred, so you don't pay any tax while the money's growing. But when you are age 59 and a half or later, when the money can come out without a penalty, both what you put in as well as all of the earnings are 100% taxable. So a lot of times people will use a pre-tax bucket in a 401k to take advantage of a tax deduction today. So if you think that you will be in a lower tax bracket when you retire, meaning you'll make more money while you're working than you might need while you're retired, the pre-tax bucket could make sense for you because you will likely be in a lower tax bracket when you retire. So taking out 100% taxable withdrawals won't affect you as much as saving the money pre-tax today. The Roth option is the opposite. The Roth contributions come out of your paycheck after tax. So in my example, $100 deducted from your paycheck on a Roth basis will net you $100 less per paycheck. The difference is that when the money comes out of the Roth 401k, both what you put in any of the accumulation or interest is 100% tax-free. So you basically forego a tax break today to have tax-free withdrawals in retirement. And when you think about kind of what what are the right ways to combine the Roths, and people ask, can I make both pre-tax and Roth contributions? The answer to that question is yes, you can combine the two. Just remember that those federal government guidelines that I shared on the first slide, the 20,500 and 27,000, is the maximum total for the combination of pre-tax and or Roth or both contributions. So you cannot put more than those amounts in pre-tax, Roth, or a combo of the two. Another question that we get when thinking about the Roth and pre-tax is there other income limits for Roth 401ks similar to Roth IRAs? And the answer is no, which is a good thing. If some of you are utilizing Roth IRAs outside of the 401k, you likely know that there's an income limit as a single filer or a joint filer on your tax returns every year. If you make over a certain amount of money, you cannot put money directly in a Roth IRA. Those same income limitations do not apply to Roth 401ks. So that's good news. And can you make contributions to both a Roth IRA and a Roth 401k? The answer to that is it depends. If you're eligible for the Roth contribution, IRA contributions based on your income limits, you can do both, which is great. And then when thinking about, is the Roth 401k right for you? Again, it is very specific to your individual situation, and please contact us if you want to think about that and talk to us individually. But there are some instances where the Roth 401k may make more sense. The first one, which I already mentioned, is if you expect to be in a higher tax bracket in retirement. We talked about with pre-tax dollars, if you think you'll be in a lower tax bracket in retirement, the pre-tax might make sense. But the opposite is true for the Roth. If you think you may be in a higher tax bracket because after you retire, you might start a business or receive inherited income or have investment property or trust property or income that comes to you, then the Roth 401k option might be better to have some tax-free money in retirement. Younger employees with more time on their side, the Roth 401k really and Roth IRAs benefit greatly from having a lot of time to be deferred and to grow and to have all of that interest that you earn tax-free in retirement. So if you're 25 today and you can give that bucket of money 40 years to grow tax deferred and then eventually come out tax-free, that has a wonderful impact on your retirement and is a good idea to have Roth assets with that long of a time frame. Highly compensated employees who can't save directly into the Roth IRA could utilize the Roth 401k, and also people who are looking to make really good tax-free gifts after their passing. A pre-tax 401k and a traditional IRA, which work very similar, are not good what's called transfer vehicles. They are going to go to the next generation, not too tax efficiently. Whereas Roth 401k and Roth IRA assets pass very tax efficiently to the next generation. So if you're looking to create a bucket of money that you would pass to your heirs or charities, the Roth 401k would be a good bucket to do so. So we'll switch gears on kind of 401k mistakes to avoid. Some of the things that we feel are kind of easy things to do. Our number one is leaving free money behind. And that kind of comes back to the match. As I said at the beginning, in order to maximize the match, you should be saving 5% of your pay or more. If you're only saving 2 or 3%, you're kind of leaving free money on the table because you're not maximizing the match. So I would recommend, if you're not saving up to the max, try to do that and then even save more. And that's kind of the next mistake to avoid, is avoiding keeping your contribution limits static. You are automatically enrolled at 3% into the 401k, which is wonderful. It gets you going and gets you in the plan. But staying at 3% for a number of years or even through your retirement, it is really not going to be enough money saved for you to meet your goals. So start at 3 if that's affordable today, but as you get pay increases or lifestyle things change, try to incrementally increase, even at 1% increases every single year to better meet your goals. And I'll share a slide and a few slides that kind of show the impact of that. We already talked about the loans and how utilizing a loan for something that doesn't build equity really isn't the great or best thing to do. And avoid doing it yourself. You know, you have at your dispense our firm to help you kind of figure out how you can best meet your retirement goals. So if you're not someone who's particularly savvy with investments or retirement planning or just planning financially in general, you know, utilize us. We'd be happy to be a resource for you. So a couple of things that tie back to those mistakes. The first one being the magic of compound interest. What this slide shows is that if you can start saving as early as possible, it really has a dramatic effect, that time element of investing and saving, on how you can grow your wealth. And what this slide shows is 2 individuals, one at age 25 and one at age 35, both saving $5,000 a year through their age 60. And they earn 6% on those investments as they go. And you can see that the person who started 10 years earlier has the ability to pretty much double or almost double what they have at the end in a bucket of money to use for their retirement. So that magic, the magic behind the compound interest, is utilizing the time and starting early and allowing that money to compound upon itself, basically interest earning interest on itself to get you to better meet your goals. And then the other thing that I had mentioned was that 1% incremental increase, or the power of 1%. What this slide shows is John at age 40 being smart and then smarter, starting with the 2% contribution, but then incrementally increasing his contributions by 1% a year until he reaches 10%. And what a large difference that makes over 25 years. This shows a 4% rate of return. But look at the difference with that static 2% contribution and an incremental increase of 1%. You have, you know, so much more money in a wealth bucket for you to use for retirement. So if you're kind of stuck at 3% that you entered in with the auto enrollment, you know, try to get yourself to move up every single year to get to a certain point that's comfortable for you, because it really can have a dramatic impact on your final savings. When you think about how you can kind of project, well, how much should I be saving? What will I have? You know, if I make these incremental increases, what kind of change would it make to my retirement picture? There's a lot of good resources out there that you can use. The T. Rowe Price website is one of them. They have some great calculators on there that you can mirror and mimic some changes in your plan, pre-tax versus Roth, as well as the mobile app, which is a very good tool. If you haven't downloaded yet, the mobile app is a great tool to use as well as the online version. The Securities Exchange Commission has some great financial planning calculators on their site that talk about budgeting, savings, college education savings, retirement planning, modeling, different rates of return, inflation factors, savings goals. and they have a lot of great tools there that you can use. And a retirement shortfall calculator that kind of focuses just on retirement and says, here's how old I am today, here's how much money I make, here's what I have saved already, this is what I'm adding into my retirement plans, this is what I think I can earn on those investments, this is when I think I may retire, and kind of looking at a specific calculator that shows you, are you on track or not, and kind of modeling those different scenarios are really good, especially for young people to kind of see, you know, where am I going and am I on track to meet my goals? So with that being said, I will end there. As I said, I want to provide my contact information so folks can get in touch with me. Feel free to call or email. And again, Katie is going to share these slides with folks so you can have my contact information, or you could take a screenshot there. I did get a few questions that came in, so I appreciate that. I will jump over to those, and please feel free to continue to use the chat box if other questions come up. One of the questions was, I have an existing 401k with Fidelity, would like to know the easiest way to transfer it over. Talked about that on that first slide. You need to contact Fidelity, ask them the best way to go about making that transfer. Can you do that over the phone, online, or with paperwork? And then having the form from us and T. Rowe Price that shows you how to make that check payable to. So we can definitely get that out to folks who need that. And thank you for that question. Next question, is there a specific time period you need to pay back that loan if you choose to take one out? Yes, you can pay that back over a 5 or 10-year period. Just know that if you were no longer employed at night shift, the balance of the loan becomes taxable to you in the year that you would leave, whether you left on your own or you were asked to leave. So there are some particulars about 401k loans that you need to be aware of. And if you do decide to take a loan and you contact T. Rowe Price directly, they will give you all of the specifics about the loan, the payback period, the interest rate, and what happens if you were to leave night shift and that taxability. So loans are good. It's good that there's a loan option, but just, you know, beware before you take the loan and know kind of what the consequences are for taking the loan. The last question I'm seeing here is the match spread out over both Roth and traditional? I.e., if you split 6% between the two types of accounts, are you still maximizing your match? Yes, if you spread out the contribution, let's say 3% and 3%, so your total contribution to the 401k is 6, you will maximize the match. But just remember that the match contribution is going to go in the pre-tax bucket. So if you're doing 6% total, 4% will be put into the pre-tax bucket. There's not the ability to match Roth assets within 401k plans. So thank you so much for those questions. It looks like that is all the questions that I've received. I appreciate everyone joining the call. I really hope to hear from you independently. I hope there was some valuable information you took out of the call today. And we'll look forward to the next time that we can chat and have another presentation. So enjoy your day, and thank you all for your time and attention. Take care.